So in tonight's show, I'm going to be talking about Christine Lagarde's appointment from the IMF to the ECB, what potentially that means, the game plan or strategy that Mario Draghi and now Christine Lagarde will probably, my educated guess is accelerate, and what's the real meaning or one of the main reasons why we're seeing either the Chicago Federal Reserve President Charles Evans and Jerome Powell talk so much about rate cuts. And I think it's probably different than the reasons that they're stating, which is they need more inflation. So I think it has to do with the two different dollar indexes and how the Fed is watching both and terrified of a stronger dollar. But before I do that in more detail, let me just give you a little recap of things. So I went on a little rant about the gold industry in general, and you guys know I've been doing this for a while. I'm very displeased with a lot of people in the gold industry. I specifically named Bill Holter. I think he's a very smart guy. A couple days ago, I talked about him being a smart guy and how some of his predictions have not worked out. And I got an email from him surprisingly this afternoon, and apparently he wrote an entire blog post on JS Mindset about me. I don't know why, because my channel's really not that big. But basically he emailed me, and there was some not so nice words in the email. I saved it. But he wanted a formal apology, so I'm truly sorry if I offended Bill Holter, and I'm also truly sorry that he misconstrued a lot of the words that I said, because I was specifically not saying that he was lazy and dishonest. If you go back and listen to the audio, which he put in the blog article, I said he was very smart, and I said some of his market predictions have not been right, but I did not say he was lazy or dishonest. I said there are other people in the gold industry, actually a good percentage of people in the gold industry, who are lazy and dishonest. So I'm sorry if I offended Bill Holter, and I'm sorry if he misconstrued some of my words. So hopefully that apology is good enough. It did sound like he kind of challenged me to a fight. Let's not go there. Okay? Let's just not go there. I have the email. It's just ridiculous. I really don't want to go there. He must think I'm small. I'm like 6 foot, 215 pounds. My body fat percentage is down to like 11 or 12%. I've lost like 20 something pounds recently in the last like 6 to 8 weeks. I lift weights like 5 days a week now. I eat very clean, except for 2 days a week. And I have like almost 5 years of martial arts training. But I don't want to go there. It's just ridiculous that someone as big as JS Mindset, and he makes a lot of money still, even though the gold community is not doing well. Anyway, I don't want to, it's ridiculous I even had to bring this up. And again, I apologize to Bill Holter. So let's talk about the actual show topics today. So Christine Lagarde, in early July, it looks like she's going to get passed through from the head of the IMF to the ECB. I honestly think really no one except for her wanted the job. It is a really bad job at this point. And it seems she's made in the past very positive comments about negative interest rates. As you can see on this economic cartoon, political cartoon or economic cartoon, which I changed a little bit, made fun of it and took out the IMF sign and put in a little ECB thing. I played around with the ECB logo, but it ruined it. So I did a little changes to make it funnier. But basically, I think what the ECB is doing and what the Fed is doing is it's getting into almost the exact same historical mistakes from the 1930s. So Christine Lagarde, and I have this article up, she's quoted as saying just how good negative interest rates are. That sub-zero interest rates in Europe and Japan are, quote, net positives, end quote, for the global economy. International Monetary Fund Chief Christine Lagarde said, I think this is from April, this interview, though she warned that the side effects of unorthodox central bank policies should be closely monitored. Quote, we see the recent introduction of negative interest rates by the ECB and Bank of Japan, though not without side effects that warrant vigilance, as net positives in current circumstances, end quote, Miss Lagarde said. And David Rosenberg, who's one of the rational Keynesians who I actually respect a lot, he actually goes through a lot of the government economic data, and he's not a brainwashed ideologue. He actually said that Christine Lagarde's appointment in a tweet on July 2nd, I'll attach a link to it. This is from a blog article from Mish. Christine Lagarde's appointment to head the ECB means Draghi's policy incursions will endure at a minimum. Yeah, I think they're gonna accelerate or escalate. Euros should be sold and rates headed even lower if that's at all possible. So I think what is at play here with Europe doing the negative interest rates, with Europe talking about more QE, with Europe potentially talking about rate cuts, is that besides bailing out European banks, Europe is also in a currency war now with the US. That maybe it took a break for a few years, but Europe, the European Central Bank, is now desperately in a currency war with the US in an attempt to devalue the euro rapidly against the dollar. Because this is the normal playbook from the textbooks of all these PhD economists. And this is going to lead to trouble. I'll talk about this a little bit later with the historical perspective and the things that follow in the 20s and 30s. So with what the European Central Bank is doing in Christine Lagarde, it's very, very dangerous. So not only are European savers and a lot of collateral damage in Europe getting absolutely hurt. The insurance companies, the pension funds, the banks themselves are getting hurt. Savers in Europe are getting hurt. The average everyday person in the European Union is getting hurt with massive currency devaluation, inflation, and taxes, and blaming capitalism too, by the way, not the politicians or central banks in most cases. And I think the Fed has saw this, and the Fed we have Charles Evans recently doing interviews, and he's talking about, we should do these 2 rate cuts despite the stocks being, the U.S. stock market being close to all-time highs. We have Donald Trump lobbying for rate cuts, and even Jerome Powell, I just saw an article, I think out today, talking about how Powell, in comments, Federal Reserve Chairman Jerome Powell added more weight to expectations. The central bank will cut interest rates later this month, stressing Tuesday that the U.S. inflation outlook is near historic lows. So I think that's their attempted cover, and maybe blaming low inflation is part of the reason. I think the main reason that the Fed wants to cut rates is the Fed is trying to prevent $2 indexes from getting too strong. So the Fed is worried about the exchange rate of the euro versus the dollar. They do not want the dollar getting too strong on the dollar index. And they also are watching the trade-weighted dollar index as well. And the trade-weighted dollar index was very close at 129 about a month ago, maybe 5 weeks. It was 4 or 5 weeks ago when I did that video, A Tale of $2 Indexes. And the trade-weighted dollar index has had a correction. The correction now, the trade-weighted dollar index has gotten knocked down to 127.8640. So the Fed actually hasn't done any rate cuts yet. They're just jawboning. But I think the reason they're jawboning and may actually cut rates in the near future has a lot to do with the fact that they do not want the dollar, either the dollar index or the trade-weighted dollar. And remember that the Fed created the trade-weighted dollar index. So this is important to the eggheads, the PhD economists, the people at the Fed who have, a lot of them are very book smart, know their Keynesian, know their theories, at least the Keynesian theories and neo-Keynesian theories well, and can do basic math, but they do not have any common sense. So they are trying to knock down the trade-weighted dollar index. They do not want that thing breaking out. So that's why you're seeing the European Central Bank, whether it's Draghi and now Lagarde, and also the other people on the other side of the Fed presidents, Trump, Powell, and I'm sure Trump has been pressuring people at the Fed and also Powell about the dollar is too strong, because Trump has talked about this. Remember, he's tweeted accusing the European Union of currency wars, of manipulating their currency. And this leads me back to the dangers that I see from a historical perspective. When these countries start talking, when you have competitive rate cuts to try to weaken your currency and devalue your currency against another, you start to get into those, and I looked this up for the exact time, the Beggar-Thy-Neighbor Policies. So let me read you the definitions of this. Okay, this is from Encyclopedia, Beggar-Thy-Neighbor. So in economics, the term beggar-thy-neighbor describes economic policies that aim to enrich one country at the expense of other countries. Most commonly, the term beggar-thy-neighbor is used in relation to such international trade policies as the application of tariffs and other restrictions on imports to protect domestic industries, as well as currency devaluations that are intended to improve the international competitiveness of the goods the country is exporting. The policy is considered to be beggar-thy-neighbor when the welfare gain in the country imposing the policy is offset by the welfare loss in the countries affected by the policy. Beggar-Thy-Neighbor trade policies could be aimed at protecting domestic industries that compete against imported goods. These policies may take the form of import quotas or import tariffs, both of which are aimed at restricting imports and also making them more expensive. For example, an import tariff will benefit the country because the tariff improves the nation's terms of trade. That is to say, by raising the price of imports, the tariff causes the ratio of export prices to import prices to fall, and thus makes the country's sales to exports to others exports cheaper, while simultaneously making the price of purchases from its trading partners imports in parenthesis more expensive. Thus, an import tariff is a beggar-thy-neighbor policy. So, import tariffs and currency devaluations. So, this happened during the Great Depression. The countries that were adhering to the gold standard, fixing the value of their currency to the value of gold, engaged in a series of competitive devaluations. In addition, many countries, including the United States, imposed protective tariffs. Smoot-Hawley Tariff Act of 1930 raised U.S. tariffs to historically high levels. Many economists have argued that such beggar-thy-neighbor policies worsened the economic decline during the Great Depression. Nevertheless, Barry Eichengreen showed that this guy, Barry Eichengreen, is trying to claim that Beggar-Thy-Neighbor did not worsen the overall Great Depression. I disagree. So this is a mainstream article from encyclopedia.com, and there's similar definitions of Beggar-Thy-Neighbor over on Wikipedia. I'm sure the Austrian school, the free market one, also has different definitions of this. But basically, a lot of the mistakes from the late 20s and 30s are being repeated. So I'll read you quickly the Wikipedia definition that's important here. Adam Smith made reference to the term in claiming that mercantilist economic doctrine taught nations, quote, that their interest lies in beggaring all their neighbors, end quote. The term was originally devised to characterize policies of trying to cure domestic depression and unemployment by shifting effective demand away from imports onto domestically produced goods, either through tariffs and quotas on imports or by competitive devaluation. The policy can be associated with mercantilism and neo-mercantilism and the resultant barriers to pan-national single markets. According to economist John Robinson, beggar-thy-neighbor policies were widely adopted by major economies during the Great Depression of the 1930s. And you know what? They are back. Beggar-thy-neighbor is back. So the Fed can claim that it needs more inflation. That may be part of the reason why they want these rate cuts despite asset prices and stock prices higher. The Fed also needs to cap interest rates for U.S. federal government borrowing because eventually those eventually those treasuries that run off will have to be repurchased. And the Fed is dumping mortgage-backed securities, selling them at a record high above the cap amount. The cap amount is $20 billion. The Fed sold for the first time last month above the cap amount, and they want to dump them all because they're going to need to buy treasuries to manipulate interest rates. So we are right back to very similar trade mistakes, unfortunately, monetary policy and trade policy. So currency war and a trade war from the 1930s, a beggar-thy-neighbor. So Christine Lagarde, I expect, will only exacerbate this. So this is unfortunately the new normal that I see, and this is why you're seeing right now the Fed has not done the rate cuts yet, and the dollar index is already it's dropped down a little bit to low 97 at 97.19. They're trying to stop that dollar index rally, and also the rally, the big breakout in the trade-weighted U.S. dollar index where it had broken out to all-time highs, that's correcting again down to 127.86. And I think a lot of that has to do with the Fed comments. And the Fed is walking a tightrope. Okay, the Fed has so many problems, so many fires, so many economic landmines to try to put out because of all the messes they made and papered over that they're trying to, okay, if they allow the trade-weighted dollar index to break out, as Rel Powell of Real Vision TV is saying, then that would potentially really, really hurt emerging markets and the $10+ trillion in dollar-denominated debt there. And if the dollar index, which is the smaller one, more about the G6, the dollar index is mostly about the dollar, the euro, the British pound, and the yen. Excuse me, I said the dollar twice. The dollar index is mostly about the euro, the yen, and the British pound. So the Fed is attempting to tightrope, walk a very thin line on both. They're attempting to stop big breakouts on both, and that's why they can claim a lot of it's about inflation, but I think the more I study this, the more I see, as a financial historian, more of the mistakes of the past, especially with the tariffs. You have competitive tariffs now with the European Union, raising tariffs on certain American goods and Trump threatening to raise them back, that we are headed towards a lot of the same stupid mistakes of the late 20s and 1930s. And we all know what happened not too long after that, World War II. So countries' economies were shattered. And another thing that also happened, and this is not talked about enough, and I was looking for a good chart for this. There's not too many good charts. There's probably one in a book, but I was searching like in Google search for it, and I couldn't find one. Is that prior to the October 29th, 1929 crash in the U.S. Black Tuesday, there was a big amount of flight capital that came into the U.S., a lot of it from Europe and a lot of it from England. So as Christine, I'm not sure how much Christine Lagarde and the other people at the European Central Bank are thinking about this, but if you listen to the Daniel Lacaille interview, that he said a lot of capital in the European Union and England has not started to come into the U.S., that a lot more could. So the more draconian that the European Central Bank, the more draconian they are with policy, with either rate cuts or negative interest rates, or I don't know what other scheme that they could come up with. But the more they do this, the higher the probability is that capital will start to rapidly leave England and the European Union and come probably to the United States. And this is very similar to what happened in the 2 years prior to the October 29th, 1929 stock market crash. The major stock market indices in the U.S. went parabolic. It went insanely high, and they were already going up, but a lot more capital came in, and I believe there was a stock market crash in England in 1927, so there was money leaving England and pouring into the U.S. at a faster and faster rate. So I would not be surprised if that happened over the next couple years as well. And I think that's why Martin Armstrong is giving interviews either on Greg Hunter, USA Watchdog, or Chris Martenson recently and talking about like 35,000 Dow or something along those lines. I don't know if he explained it as well as I just did, but based on the policies that these central banks are doing, and now you have, I think there's a lot of evidence that the Federal Reserve and the European Central Bank are in a currency war and a trade war, and they're willing to do all kinds of crazy beggar-thy-neighbor policies, and it's just going to escalate. I wish it wouldn't, but unfortunately, it seems that all these, whether they're PhD economists at the Fed or people at the European Central Bank, they're going to be doing pretty much the same playbook, and they're going to be playing off each other. Because it seems to me that the European Central Bank wants a much weaker euro, but the Fed does not want a weak euro, because then a weak euro normally means a strong dollar. So the Fed doesn't want that. Trump has said he doesn't want too strong of a dollar. So I think that's why you're going to see the Fed continue to jawbone about rate cuts until they actually start to do rate cuts. Vorza brought up Bitcoin. So it's interesting about all the crazy stuff going on with Bitcoin lately. I said something interesting. I came up with an interesting theory. I'm not sure how true it is, but there's some circumstantial evidence for it. So I was sending around to my buddy Phil Kennedy and also Naomi Brockwell, who's big in the Bitcoin community. I went back and looked up the speech from the March 2019 DC Blockchain Summit that the head of the CFTC gave. I think his name's Christopher Giancarlo, or J. Christopher Giancarlo, or something like that. And he's in the Trump administration, head of the CFTC. His wife is a top SEC lawyer, and he gave a speech talking in March of this year, talking about how he owned Bitcoin, his wife owned Bitcoin, his kids own Bitcoin, how he is a crypto family, and how the CFTC is going to be a do no harm. I think the Facebook going for Libra stuff, I think what happened is the Wall Street banks and the Fed got spooked about that someone who's not a old boys Wall Street club was trying to get into the, money transfer business. Because remember, PayPal was treated so bad initially when they tried to even get into that. And I think what happened is Trump was maybe either he offered a deal or someone offered him a deal to say some nasty things about Bitcoin, even though there's people inside his administration who actually like it. And I think Trump was offered a deal that if he tweets bad things about Bitcoin, that he would get his rate cuts faster. I think there's a decent probability that that's true. I'm not 100% on that, but I think there's a halfway decent probability that that actually did happen. That the Wall Street, the Fed, the large banks said, "Hey Trump, you need to put out a bad tweet about Bitcoin and you'll get your rate cuts faster." I think that's part of it too. The people in power really do not like Bitcoin. They don't want a technology company doing like money transfer. They don't want any of that stuff because remember Trump's tweets talked about how Facebook would have to get a banking license. I don't think they're going to get a banking license. I know Facebook is rich and powerful, but it's like an old boys club. So the Fed and the large Wall Street banks that own the Fed, I don't think they want another tech company from Silicon Valley getting involved in that. Okay, so moving on, I have articles about some of the other stuff with Beggar-Thy-Neighbor if you want to read about it more and some of the comments from the Fed people. It's just going to get worse. It's just going to get worse, and this is all about no one wants a strong currency. No one wants a strong currency. So the European Central Bank, they're deciding that they want to try to weaken the euro, and they're doing that with negative interest rates, probably rate cuts. They're already doing QE. They may even increase it. There's a number of different reasons why these things are happening, but we're looking at, I think, an escalating currency war and an escalating trade war between the US and the European Union. In the past, especially after the 2008 financial crisis, the European Union did a lot of the things that the Fed and the US government wanted, and I think those days are, there's a big schism there. I think it's every country for themselves at this point, because they are fighting over a shrinking economic pie. The real global economy, the real economic pie is shrinking. It's not, oh, we still have GDP growth. It's nominal GDP growth, not counting a real inflation rate. You know, the governments are saying, oh, we don't have enough inflation. Meanwhile, people in the European Union, people in the US are being killed with stagflation and taxes. And the government's just claiming, oh, we don't have enough inflation. The asset prices, a lot of them in the US are up like crazy. So we could have a lot more flight capital coming into the US if some of these other countries, especially the European Union, start and escalate these policies more. Because I think Lagarde's going to do even worse than what Draghi did. So let me talk about the gold market. We've had a rally in gold. So I think people are starting to worry about the comments, the fight between the Fed and the ECB. All these comments are starting to really worry people. Back and forth that, oh my God, we're going to have another currency war. This trade war is going to escalate. This is going to be a mess. And I think that's probably why gold has had a big rally up to 1427 when I'm looking at the screen now, and silver's right around 16. This is a decent price for silver. Silver is not at a level yet where a lot of the primary silver miners can go and raise a lot of money, but gold has been, and remember I predicted that this would happen. There's an article that came out on Seeking Alpha. Ida Rant writes, I think every couple weeks or once a month, it's a resource sector digest, and he tracks a lot of these capital raises, and a pretty good amount of either small producing gold miners or near-term producing gold miners or juniors have been raising a lot of capital lately, up to $25 million on deals. So there's been between a couple $1 million and $25 million raised by a bunch of smaller miners lately. 25 million is probably not enough, but it sounds like some of these miners are doing massive dilutions. So I don't want to pick on one company too much, but it looks like Jaguar Mining just did a massive amount of share dilution because their mines are not profitable yet. They haven't gotten their costs down. They're having operating problems at the mine. I think I saw on a press release that they just diluted their shares over the last 8 months by over 100%. They went bankrupt once too. I think 2 years ago, year and a half, 2 years ago, something like that. They went bankrupt. So it appears that this is the problem with miners. They could have a good mine on paper and the project economics can look good, but if the mining company does not execute, then the company's in trouble again. And it's right back to the games of diluting shares, reverse stock splits. It's very frustrating. And this is why I don't really like gambling on junior producers or junior miners anymore. You can make hundreds of % returns if you know what you're doing, but if the management team, if you get something wrong, if you get the balance sheet wrong, if the mine doesn't come in on time and on budget, there's going to be hell to pay. You're going to lose a lot of money very quickly. And let me see if there's anything else. Oh, okay. So I wanted to talk about Beyond Meat in this quick little update. So Beyond Meat, I talked about it, I think it was either May or I think it was May. I can go back and look. But the IPO was very successful, and the lockup period has not expired yet. Remember, I told you to go and find out if, this is not financial advice, but if you're going to do research and go do a trade on this, number one, I thought the stock would be extremely volatile up and down. So I think it's going to be extremely volatile. But number two, go and find out when the lockup period is, when the insiders are actually allowed to dump 70, 80, 90% of their shares. Because once the lockup period is over, I think the stock's probably in a lot of trouble. There's a lot of companies, whether it's Nestle or Tyson Foods, are coming out with a lot of competing products, some of which are a lot healthier. Some people are saying they're not as tasty, but the way this is just cooking advice. This is not financial advice. This is cooking advice. If you want to cook healthy, you use spices. So use a bunch of different spices instead of fat. So you can use some fat. Some fat is healthy, but if you want to eat healthy, the way to cook tasty without a lot of fat, a lot of butter or other fats is to use a lot of spices. So there are a lot of competing products out besides Beyond Meat that are coming out down the pipe, and this is not like a business with a large moat that's going to have super high margins. They're not even profitable yet. They're just booking deals right now. So it's a revenue-only company with a 10 billion market cap. So the stock price did temporarily, I think, I talked about it early June, it looks like, because the stock chart went up to like $168.10, and then it crashed down temporarily to $126. And I said that it probably, because the lockup period wasn't over yet, that it would probably rally from then. But if you had options trades with puts and calls, if you had volatility trades, stocks with lots of volatility offer you both up and down the ability to make money. So if a stock is flat, this is not financial advice, but if a stock is flat and you're a trader, there's only a couple options trading strategies that you can make money. One of them is like buying the stock and selling covered calls and just renting out your stock. But you really need to make a lot of money in a short amount of time as a trader. You need volatility. If you're not going to use leverage, if you're not going to use debt and margin, again, obviously, most people should not be using debt and margin. That's not financial advice. But if you do have, if you're going to get leverage, you can get leverage in options without using debt and margin. You can get leverage, but if you mistime that, you can also lose your money too. So options trading is dangerous. But if you're a financial professional, fundamental research, technical analysis, and then you want a little bit of leverage on your trades without taking on debt, you can use options trading, puts and calls, and you can also use puts and calls for hedging. And so Beyond Meat, which is BYND, and that stock has rallied from 126 up to 169 again. So eventually this thing will be held to account. I don't think any food company wants to pay $10 billion for a company without much intellectual property and that doesn't have any earnings. I don't think any of the large food producers want a company like that. So at some point, I would watch the lockup period. This is not financial advice, but just my opinion. I would watch the lockup period on that. So 6 months, a year from now, it's going to be extremely volatile going forward. So we could see days where they bomb, they don't have enough revenue growth, and all of a sudden the stock's down 20%. We could see days like that, and then they issue a press release that they just got a deal for more revenue growth, and the stock's back up 50. With a short squeeze and shorts recovering. We're going to see that type of volatility in that stock, I expect. And we've seen it already around June. There's a big spike in the charts there after the IPO. But at some point, from an educational standpoint, the way that these IPOs work, especially if the company's not profitable, not generating free cash flow, and has questionable fundamentals, as Beyond Meat does, because their margins and I talked about this on my actual specific show for this, that their fundamentals are very questionable, that at some point the insiders will say, you know what, I've made 10 times or more of my money on these shares. I'm going to sell most of my shares. I'm going to go buy some real estate. I'm going to live like a king for the next 10 or 20 years or something like that, or retire early. Okay, so I think I've covered pretty much everything that I wanted to touch on. I'll take a look at listener questions and comments now. So again, I apologize to Bill Holter. I do not apologize to most of the gold community. Unfortunately, you guys have to do better. If there's hundreds and hundreds of interviews of lots of people out there making ridiculous predictions, and I can't name any specific people, I'm sorry. But if there's ridiculous predictions out there, just tell people you screwed up. Tell people you're working hard, learning more, getting better. I don't know. I've tried to do that. Apparently, a lot of people in the gold community, that's not acceptable. There's going to be another blog article probably on JS Mindset saying my apology wasn't good enough. Okay, I'm looking at listener questions and comments now. First of all, thank you for the $1 super chat. Okay, I'm trying to read that name. Caesar speaks. Ho Caesar speaks. Okay, I think I said that right. The silver miners have had a big rally. Lately. I think Alexco was up like 9 or 10% in one day. So they do have this is not financial advice, just my opinion. They do have a really good project in Canada. So it's fairly geopolitically safe. It has pretty good grades. They've got the cost down quite a bit. So it is a pretty decent project. I still think, again, this is not financial advice, I think Pan American Silver and First Majestic Silver are very safe. First Majestic Silver appears to be through their big production problems at San Dimas and Santa Elena. So First Majestic Silver appears to be much safer. We'll see what they decide to do. I would like to see some of these companies do some acquisitions, but I think most of these mining companies don't have the balance sheets to do it right. I think Bitcoin's a speculative vehicle. I think this is not financial advice. I think it's okay to have some Bitcoin in your portfolio to hedge your gold and silver and your stocks or your rental properties. Maybe a couple other cryptocurrencies. I wouldn't go crazy with cryptos because these governments, I don't know if you guys saw this, but the People's Bank of China, they had been testing a government cryptocurrency for the last couple years, and they just announced like in the last couple weeks that the tests were a success. So I don't know what China has planned. I know China in a lot of the major cities is already doing a version of a cashless society because you have to pay with your smartphone. You have to use Alipay or WeChat, and then there's QR codes. So in a lot of places in China, there is no cash accepted because it's either it's a hassle or a lot of it's counterfeit there. But it looks like the Chinese government has already hijacked blockchain technology, and they're not too far away from launching a digital RMB. So the Chinese version of FedCoin. Which, as a libertarian, this is my nightmare, because then you're going to a full totalitarian government where they can track and tax every transaction. This integrates with social credit score. And then, if you do this podcast and the government doesn't like it, all of a sudden, there's your bank accounts are shut down, your credit cards are shut down, you're taxed extra, that type of BS. Yeah, the PBOC coin, you can look up the articles, it's centralized. It's like a Fed coin, which is what Eric Townsend of Macro Voices has talked about. I interviewed him earlier this year about this, and Eric Townsend, if you want a pretty good book, Eric Townsend has a book out. You have to go to the Macro Voice. It's not on available, I don't think, on audiobook on Audible or Amazon. I'm not sure why, but you have to go to the Macro Voices website to buy the audiobook. But he talks about, he was a successful software engineer and computer programmer, and he made a lot of money during the dot-com bubble, and he sold out. He sold out before it crashed, and he made a lot of money. So he has a computer programming background, and he's a libertarian, and he is really worried that the governments will all hijack blockchain technology and force a cashless society. No, I'm not on Steam it. I've had like 4 or 5 friends listen to the stuff that Bill Holter's citing, saying that Bill Holter's taking it way out of context, but I did apologize to him, but whatever. I mean, he's still making good money. I don't know why he's complaining about me. I don't get 100,000 or 200,000 views on any of my interviews. That took me years and years of hard work to get my first 100,000 views. Okay, guys, well, that's it for this short little show. No, Michael says gold-silver ratio means diddly shit. Actually, what it means is the silver miners, if the gold-to-silver ratio doesn't improve, it means that the silver miners a lot of them are going to go bankrupt. That's what it means. It means that the silver miners had to transition to gold mining. No, I have not watched the hearings on Libra Coin. I watched a live stream show, part of it, from Nomi Brockwell with Caitlin Long, who I've interviewed last year. Bitcoin was a Trojan horse to bring in the cashless society. There's a high probability that that's true. That doesn't mean you can't make a lot of money trading cryptocurrencies along the way and then take the profits out and go buy real stuff. Go buy gold, go buy real estate, go buy, I don't know, a business. That's not financial advice, just my opinion. Okay, well, I think I'm done with the show for now. I'm sure I'll get another email. Okay, bye for now, guys.